Hey everyone, welcome back to Corporate Decoder, the place where we decode what really matters in corporate filings. And let me tell you, this latest report from Blue Owl Technology Income Corp has some juicy details about how they run their money, making machine, and we're going to figure out if it is a well-oiled one or a leaky old jalopy. Before we dive in, if you are all about getting the real story behind company reports without the jargon, make sure you are subscribed. And hey, we've got a fantastic community over on Discord, linked in the description below, where we break down these filings even further. So what we have here is a current report, basically a snapshot of what has been happening with Blue Owl Technology Income Corp. On the 23rd of October 2025, they're telling us about some unregistered sales of their stock, which basically means they sold shares without having to go through the whole big public registration process. They sold about 4.2 million shares of their Class I common stock for almost $44 million. Now, why they did this privately is something we'll dig into, but it generally means they're dealing with specific investors, likely big ones, and doing it quickly. This table is where it gets interesting with that private sale. They sold a significant chunk, over 4.2 million shares, and raked in nearly $44 million. The finalization date of the 23rd of October is important because it tells us this is the most up-to-date number they're reporting. It's like they made a deal earlier but officially closed the books on this specific sale on this date. Now, let's talk distributions. Think of this as the company paying out profits to its shareholders. They declared a monthly distribution on the 5th of August that was payable by the 30th of November. The important part is the net distribution per S-share for each class of stock. For Class S shares, shareholders got about 6.7 cents per S-share after fees, Class D got about 7.2 cents, and the Class I shares, which are often for larger or more sophisticated investors, got the highest payout at nearly 7.5 cents per S-share. This tells us how the company is returning value to its investors. The Class I shares getting the highest net distribution is a common structure. They often have lower fees associated with them, meaning more of the gross distribution makes its way directly to the shareholder. And here is something crucial. The net asset value, or NAV, per S-share for all classes, SD and I, was $10.42 as of the 30th of September. This is the true value of each share minus the company's liabilities. Companies that sell shares based on NAV are aiming for a price that reflects their underlying worth at that moment. This part talks about their ongoing offering, where they are continuously selling shares of their stock. They've got a current offering for up to $5 billion and initial offering, also for $5 billion. On top of that, they've made those private unregistered sales we mentioned earlier. This shows they're actively raising a lot of capital. Looking at the totals here is like looking at the company's active fundraising. As of the filing date, across both their public offerings and the private sales, they've issued a massive 378 million shares and brought in almost $3.9 billion. That is a huge amount of money flowing into the company, and it suggests strong demand for their shares. The asterisk notes that this includes some seed capital and money from affiliated entities early on, which is pretty standard for setting up a fund. Now, let's look at how they're using debt. This section shows their borrowing capacity and what they've actually borrowed. They have a revolving credit facility where they can borrow up to $1.05 billion and have currently drawn $702 million. They also have several other SPV asset facilities and notes, which are essentially different types of loans tied to specific assets. The total debt picture here is significant. They have access to $3.745 billion in committed debt and have drawn down $2.716 billion. This shows they are using leverage, which can amplify returns but also increases risk. Roughly 96% of their drawn debt is at floating rates, meaning their interest costs will go up and down with market interest rates. That is a key risk to watch, especially in a rising rate environment. This is a portfolio update telling us where the company's investments are focused. As of the 30th of September, they had investments in debt for 178 companies, totaling $5.8 billion. Most of it, over 90%, is in first lien debt, meaning they are the primary lenders and have a strong claim on assets if a company defaults. About 1.1% is in unsecured debt, which is riskier. They also have some preferred and common equity investments. Importantly, almost all their debt investments, 99.2%, are at floating rates, again highlighting that interest rate risk. This table breaks down their investments by industry. You can see system software at the top with over $795 million invested, making up 13.5% of their total debt investments. Healthcare technology is right behind it. This diversified approach across different sectors is generally a good sign, reducing reliance on any single industry. Here we see other industries where they've placed their bets, like insurance and diversified financial services, each making up about 6.7% of their portfolio by par value. They've also got exposure to healthcare providers and services and professional services. It is a broad mix, which is typical for a company focused on income generation through debt investments. And the grand total for their debt investments, $5.833 billion. So to recap this section, they're a major player in technology and healthcare debt, holding over $5.8 billion in investments, with the vast majority being first lien and floating rate. Now, this is your standard disclaimer, but it is important. They're saying that because an investment did well in the past, it doesn't guarantee it will do well in the future. They can't promise you'll make the same kind of money or hit any specific targets. This is crucial for investors to understand. This paragraph is all about forward-looking statements. These are basically educated guesses or projections about the future. They use words like may, will, should, expect, project, estimate, intend, continue, target, or believe. The company is telling you that while they believe these statements are reasonable now, actual results could be very different due to the unpredictable nature of business and the markets. They are warning investors not to hang their hat solely on these projections when making investment decisions. And here they're being extra cautious. They're saying that all these numbers and estimates are just preliminary. The final numbers you'll see in their more detailed financial reports like the 10Q or 10K might be different, and those differences could be significant. They're essentially telling investors, this is our best guess right now, but the final picture might look different. They also explicitly state they're not obligated to update these preliminary estimates unless the law requires it. This is another critical point for investors. They're telling you that their accounting firm, KPMG, has not officially audited or reviewed these preliminary numbers. So, take them with a grain of salt. KPMG isn't giving any assurance or opinion on this information. Alright, let's wrap this up. Blue Owl Technology Income Corp is a company that is actively raising a lot of capital, both through public offerings and significant private placements, bringing in billions of dollars. They're heavily invested in debt instruments, particularly first lien loans with a strong focus on technology and healthcare sectors. Their strategy involves using a fair amount of debt, and a large portion of that debt is at floating rates, which makes them sensitive to interest rate changes. What does this all mean? On the one hand, their ability to raise so much money and deploy it into investments suggests they have a strong track record and investor confidence. Their focus on first lien debt provides a layer of security. However, the substantial use of floating rate debt is a notable risk. If interest rates keep rising, their borrowing costs will increase, potentially squeezing their profits and affecting those distributions to shareholders. The company is also being very careful about its projections, emphasizing that the numbers presented are preliminary and unaudited. This is a sign of good corporate governance, but it means investors need to wait for the more detailed, audited financial statements to get the complete picture. Overall, Blue Owl Technology Income Corp appears to be a significant player in its market, actively growing its assets under management. The key things to watch are how they manage their floating rate debt exposure, and whether their investment strategy continues to generate consistent returns in a potentially challenging economic environment. We'll be keeping an eye on their future filings to see how these preliminary numbers hold up and what the long-term trends look like. Alright, that is our breakdown of Blue Owl Technology Income Corp's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more deep dives into the world of corporate finance. Don't forget to check out the Discord community linked in the description. It is a great place to continue the conversation. Thanks for watching, and we'll see you next time on Corporate Decoder.